Bloomberg Audio Studios. Podcasts, radio, news.
Now, Standard Chartered is set to return another $1.5 billion to shareholders. This as the London-based lender reports fourth quarter earnings that beat estimates. Let's cross over to London right now, where Bloomberg's Anna Edwards is standing by, ready to speak to the CFO of that bank. Anna.
Thanks very much, Tom. Yeah, I'm really pleased to say I'm joined by Diego Giorgi, who is the CFO of Standard Chartered and joins me here on set in London. Diego, nice to have you with us this Friday morning. Thank you for coming in. So the numbers themselves coming in better than estimates, returning $1.5 billion to shareholders. You've given some guidance this morning. I wonder whether the guidance looks a bit conservative. That's one of the conclusions coming out of one of the analysts this morning. How do you rationalise the guidance you're giving?
Well, look, we upgraded our guidance at Q3, and in the meantime, we have delivered another strong repeat performance by our engines of growth, financial markets, banking, and in particular, our wealth management business. And it's really been consistent delivery quarter after quarter. And that has allowed us to reach 11.7% return on tangible equity, which is a 160 basis points increase on last year. When you think of it, we're really delivering top-line growth, 14%, and we are marrying with returning capital to our shareholders, and we've announced, as Tom just said, another $1.5 billion buyback,
yes.
Which, when you think about it, really means that we are delivering what we have promised to our shareholders, which is sustainably higher returns from our high-growth business in our high-growth markets.
Okay, and a lot of banks have had the experience of being assisted in this activity by higher interest rates, and net interest margin benefits from those higher interest rates. What are you assuming for this year? And therefore, could your numbers do better if rates are not cut as much as maybe we were expecting recently?
So the environment might be a little bit more conducive than we were expecting up until a few months ago. But first of all, let's remember that in terms of contribution to the top line, our net interest income contributes about 50%, and our non-net interest income contributes about another 50%. Non-net interest income has very strong engines of growth, up 20% last year, as we have just discussed. And in terms of net interest income, we have been building up our hedges, de-risking the delivery of net interest income, and I think that positions as well for this slightly more uncertain world.
Okay, so let's turn to the other part of that of the income stream and away from net interest margin and the other areas. One of the areas I want to ask you about is global markets and what you've managed to achieve there in the global markets business, getting a boost from some of the volatility in markets. It seems traders doing well on that, and that's been a story across Wall Street, across lots of the banking sector. Thing is that sustainable in any way? Do you have any visibility on whether that kind of performance is sustainable?
So I think it's sustainable for us. And the reason is that our markets business, as we often like to point out, is a peculiar type of market business. Because we are a giant connector bank, really 75% of what we do in markets is helping our clients manage their exposures to foreign currency, interest rates, and other risks. That is very recurrent activity. When volatility then spikes, we add to it performance in helping them take advantage of those market dislocations. But the delivery of our financial markets numbers is highly de-risked once again by this attractive complexion of the business, and it's business that, by the way, grows well. We pointed out at Q3 at our last set of results that this part of the business grows at almost 10% per annum, and it's been doing so for 5 years.
Yeah. Okay. So you're confident in the sustainability of the performance there. In terms of the wealth management side of the business, or managing money for increasingly wealthy people, that's another revenue stream that you have. What do those conversations look like at the moment? Are global investors, are they talking about, well, there's still no alternative to being invested in the United States and that tech story, or is it a much more global narrative? How is it shifting?
So for us, for Standard Chartered, it's a very global narrative, in particular because of the nature of the wealth management activities that we do. While we are present across the continuum of wealth management, all the way up to the private bank, the core of what we do is really with affluent customers. These are customers that have with us $500,000, $1 million, $2 million. These people really save and invest with us. So that kind of debate, although the type of products that they use might be shifting over time, is really focused really on the long term. From that point of view, of course, we are assisted by the incredible secular trends that we have in our markets. Our markets are the fastest growing ones in the world, and the places where most of the wealth, 2/3 of the wealth of the middle class over the course of the next 5 years is really going to be created in Asia, Middle East and Africa.
Yeah, and that's where the business is focused. Let me ask you about the share price performance, because Bill Winters, the CEO, quite famously recently described, or a year or so ago, described the performance of the shares as crap. I wonder if you have a different word that you'd like to use now, because now the stock has caught up with the rest of the European banking sector.
So, one word, 3 words, more to do. I think we've done well. I think, and by the way, we don't manage to the stock price. I mean, we manage the bank. We try to deliver sustainably higher returns. We try to return excess capital after we have invested heavily in our business so that we can deliver those sustainably higher returns. But it's true that we've had a good performance. But we keep our eye on the ball. We continue executing, and we hope that the market will continue to reward us. But there is more to do, no doubt.
There is more to do. Okay, we take that message. In terms of the way that you reward staff, we're sitting here in the UK, Diego, and here in the UK, you've got more flexibility to pay staff with bigger bonuses since some recent regulatory changes. How important is that in the global competition for banking talent?
Very much so, Anna, in the sense that it's truly a global competition. And look, a few things here. We've always been aligned with the industry, and we intend to be aligned with the industry going forward. And this shift towards more performance-related pay, I think, is ideal. It aligns the interests of our colleagues with the interests of our shareholders, and it enables us to attract talented people, which is what we need in order to serve our clients in these uncertain and more fragmented times.
Yes, more uncertain, more fragmented. And you've mentioned how some of that volatility helps on the global markets business, for example. And there's a lot of need to perhaps hold investors' hands through a lot of this volatility. I wonder if that drives opportunity, actually, when you're managing money for wealthy global investors. If there's a lot of volatility and a lot of uncertainty, does that mean they require more or different things from you?
Very much so. And by the way, allow me to take one step back for a second. There is a lot of discussions about deglobalization, lack of growth, etc. First of all, the world is growing strongly, and it will continue to do so. Deglobalization is just globalization shifting towards new corridors. And these new corridors of growth that globalization is shifting towards are the intra-Asian, Asia to the Middle East, Asia, Middle East and Africa corridors that Standard Chartered really sits astride.
But there's less overlap between those corridors in a deglobalized world.
There might be, but the diversification effect of all of that will lead to a continued set of flows which are going to be more fragmented. And that fragmentation, that complexity of navigating this environment is what our clients look to us for help.
Diego, thank you so much for joining us. Very nice to speak to you this morning. Diego Di Giorgi, the CFO of Standard Chartered.